This is Mitch, and welcome to the Real Estate Investor Summit podcast. I have David Dodge on. Man, we interviewed one time and a while back, so be sure to check out our other interview. But then we got along together so well, I invited him down to San Antonio, which he was there in like no seconds flat. Like the next day,
You didn't think I was going to come, did you?
Yeah, he's like, hey, why don't you come to my ranch? He goes, oh, I think I will. And like the next day I open up the door, he's standing at my doorstep. So we went out to the ranch, man, and we had a good time, shot at some hogs, and just basically got to know each other and had a blast. But I recognize there's another topic that we can talk about together. And it's raising private money or using private money or how to find private money. I mean, we're just going to kind of cover the private money, private lender scope here. So, hey, David, how you doing?
I'm doing great, Mitch. Thanks for having me, man. Good to see you again.
Yeah. So, and then he was down in San Antonio with a mastermind, and he got me invited for a day at the mastermind. So I went to the mastermind, and they were very gracious, very nice people, allowed me to sit in as an outsider and kind of got to shoot the bull with them and run some things back and forth. But it was a great time. This guy's a real doer. I mean, he does over about 100 houses a year, about the same as my organization. He does buy and holds. He does wholesales. I mean, what you said you do about 33. What were the categories?
Yeah, so I do about a third. So I do a third wholesale, a third rental properties, and then a third fix and flip. So no matter what, everything is bought at a discount, right? And we buy everything with private lender funds. So we're borrowing from private lenders. So we're always paying cash. No matter what the exit strategy is, Mitch, we're always paying cash. And the reason is because, you know, all we really are doing as real estate investors is we're trading convenience for a discount. And that's really all it comes down to. So no matter what happens after you purchase the property, if you decide to wholesale that property, if you decide to keep it as a rental property, if you decide to fix and flip it, or in your case, if you decide to own or finance it, none of that really matters if you're not buying it at a discount. So one of the best ways that we're able to buy at a discount, Mitch, is to provide cash. And really, what does that mean? Well, it's convenience. We're providing convenience. We're coming in and we're saying we don't need to have, you know, a month or 2 or 3 of inspections. You know, the inspection period is
appraisals, inspections.
Yeah, all that stuff, inspections, appraisals, all this stuff. You know, typically we do have an inspection period. I don't want to mislead the listeners here. We definitely have an inspection period, but typically that period's anywhere between 3 and 10 days. And we provide cash. We buy as is. And we make it easy. So a lot of times, you know, people will have properties that they're embarrassed to show, or they have their hoarders, or they don't want to make repairs. And, you know, our model is, you know, we come in and we make it easy. You can leave all this stuff behind, Mr. or Mrs. Seller. You don't need to fix that sink that's leaking. You don't need to do anything. You know, we are going to basically provide cash. Another way to look at that is convenience to the seller by making it easy, simple, quick, you know, so on and so forth. And in return, all that we ask for is a discount.
Yeah, you're gonna have to pay for that stuff anyways. So we call them situational properties, Dave. You know, we either deal with situational properties or people in situations. So, you know, people go, well,
how do you know it's a booming market? How do you buy so many houses? So, well, it's a booming market, but I live where there's 2 million people. What's the population where you're doing business?
The population where I'm doing business, we have about 2 million people.
Yeah, that's what I have. So among 2 million people, there's someone dying, divorcing, getting ill, driving off. You know, there's a million reasons, but the long and short of it is we live where the change is, and a lot of that change. I mean, there's always change where there's death and illness. You know, whether we like it or not, we didn't cause it. It's just going to happen, and someone's got to deal with that change. And so we're there to help people transition, give them at least 1 or 2 options that we can do for them. There's other options, of course, too. And we just, you know, find enough people on an annual basis that like the option that we offer best.
And that's exactly right, Mitch. You nailed it. Absolutely.
So it's a numbers game. You got to, you're not going to get everyone you go out there, right? So, but the reason why I want to talk to Dave is I wanted to hone in on this private money and how important it is. I have a course that's called Private Money Changes Everything. And I have $22 million worth of private money. Now, don't freak out. That didn't happen overnight. I didn't meet a rich person with $1 billion who saddled up with me and said, okay, I'm in. I didn't get lucky. I honed this $22 million over 22 years, okay? And the hardest person to get was the first one. And then the second one was a little easier. And then the third one was a little easier. And then pretty soon they all became no issue because I had a long track record of paying people on time. How important is that, Dave? Like,
oh man, there is scenario, in all businesses, Mitch, you have ups and downs, and paying people on time consistently is the most important.
Whether you're up or down, you got to pay on time.
And that's what I was getting to. No matter if you are doing awesome in your business or if the walls are caving in, your number one priority is to make sure that the private lenders get their monthly payments and or that you are protecting their capital. Absolutely.
Yeah, we got to protect their interest, make sure their paperwork gets filed, make sure that, if you tell them they're going to have a first lien, make sure they get a first lien and make sure it happens within a day or two, if not that day, if you can, because the biggest anxiety especially for a new lender, the anxiety is always between when he let go of his money and he sees those papers filed at the courthouse.
That's right.
That's the anxiety period. And you want to limit that as much as you can. So I want to, there's a lot of people out there that it's costing them a fortune because they don't readily have the money available. They don't know that they have money behind them backing them up. I say, like, I know and so we'll go out, man, you and I will go out and make a offer on a hotel that's, early in our career might have been way over our head, might still be way over our head today, but we're not worried about that because we know good deals bring money and we know where to find it and we have this confidence. So let's start out with the new guy who doesn't have any private lenders and he really wants to conquer that fear. First of all, let's start out with, what does a private lender look like? What does yours look like? And then I'll say what mine look like. Like, what's the typical private lender that loans you money? Who is he or she?
It's a great question, Mitch. I love that. Let's jump in. So the typical private lender that we work with is either, so some of them are also in the real estate industry, meaning that they have rental properties or that they flip houses. And some of them are not. For me personally, the majority of my lenders are. Now, it doesn't mean that they have to be. And the reason that the majority of my lenders are is because I met these lenders at real estate investment clubs, at RIAs. Okay. So if I was searching for private lenders outside of RIAs, well, then it would make sense that they probably aren't in real estate. But the people that I've sought out, I met them at real estate clubs, and they also have rental properties. They also do fix and flips. And typically the investors that I work with, they're older and they don't want to work, 50, 60 hours a week where I enjoy working. So I'm usually putting in that amount of time. And they know that their investment with me is secured by a piece of real estate. They also know that I'm buying everything at a discount, right? Boom, 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 discount. Don't forget that. So if you're not buying at a discount, it makes it very difficult to make money in real estate. And whenever
it makes it very difficult to borrow the money because no one wants to loan.
And that too. Absolutely. Right. So everything that we do, we buy at a discount. We use private lenders to purchase those properties. The private lender is backed, their money, their investment into me or my business is backed by that piece of real estate. So we put,
and you do that by giving them a first lien, right?
We do that by giving them a first lien.
I give my private lenders a first lien, but my commitment to them is, so I had this big fear. My fear was that I would fail them. What happens if I fail them? And I would rather die than fail my private lender. You know what I mean? So
me too.
But the truth of the matter is, what I was worried about was catastrophic. Like something catastrophic happened in my area or to the nation. And I was still worried about that because, I can promise these people everything I want to promise them, but if something really goes bad, I could go under. Like, for example, Kim Jong dumbass over in Korea drops a dirty bomb in downtown San Antonio and pollutes a 20-mile radius of, you know, of property with radiation. You know, I mean, that's not my fault. It's nothing I did. But I still, you know, if I said I'm going to promise to pay you, then I would still feel horrible because I had promised. I didn't make any exceptions. You know what I mean? So
yep, absolutely.
I didn't say except for if there's a catastrophe. I didn't say that. So what I basically did was, in order to get over that, I just went right to, you know, I have this theory. When you're afraid of something, go right to it. Like if you're showing a house and there's a really ugly part, go to it first.
Go to that first.
Put it right out there. You know what I mean?
I love that, Mitch. That's a great strategy.
If you're afraid, you know, if you're afraid of this one aspect of the real estate business, like you're afraid of contracts, then don't do anything else until you get and you whip that all together. Get with someone, have them coach you, pay them, go over the contracts 100 times till like, okay, I don't even know what I was afraid of anymore. You know?
Right. I love it. Absolutely. And I agree 150%. I love it.
I was afraid of this. So what I did was I just proposed a way that I want to borrow money that eliminated my fear, which was, this is how I loan money to my people. Look, I'm going to give you a first lien and you're either going to get paid or you're going to get my house. I have two rights every day of my life. I have the right to pay you as agreed, whatever the interest rate, whatever the term, or I have the right to walk you down this deed. That's my two choices every day. So if you don't like this house that I'm pledging, or this piece of property that I'm pledging as your collateral, because it's a collateral only loan, it's a non-recourse loan, it's either get paid or get this house. If you don't like this property, don't do this deal.
Yep. And you know what? Now that I think about it, Mitch, yeah, absolutely.
Now here's the thing I promise. If I'm alive, you will never have to foreclose on me and chase me. If I can't pay you, I will come to you with the deed to your house, which is part of my commitment. If I can't pay you, like you said, it's never happened. Hadn't happened to me in 22,000 plus houses, you know, since 1996. Never happened. Don't think it's ever going to happen. But I'm just saying, that's my two rights. And now I can always, unless I'm dead, and if I'm dead, I guess it doesn't matter. I can always perform one of those two things. So there's no way I'm not keeping my word. My word is going to be good from now till I'm dead, right? And even beyond when I'm dead, because my office and my partners all have the same culture. We've been doing this for 24 years. If we can't pay, you won't be chasing us for it. And the other thing is those people that don't pay but collect the money anyways, they're collecting but they're not paying out. Those people need to be hung, in my opinion. That's what the old West, you just put them on a horse, put them under a tree, put a rope around their neck, just hang them. No, because that's just bullshit. You know?
I know, I'm with you.
If you get paid, you got money to pay.
Yep.
You know, if you don't get paid, okay, I understand. And then you can call up and say, hey, you want to give me a few months, or you want me to walk this deed over to your house? You know, you just be honest and tell people what you do. So that's how I learned how to sleep at night, Dave, was just get it off take what scared me and get it off the table. And,
right.
And if you don't want to do it, don't do it. If you do want to do it, it's good. So like, I have $22 million worth of debt back there. A lot of people go, aren't you scared to death? I go, no, I'm not scared to death. I need $44 million worth of debt.
That's right. That's right. I probably got about 5 million right now. So,
you know, my bank,
I'd like to get to 50.
My bank says, like, so how much do you owe? I said, well, like 22 million. They go, my God, that's a lot of debt. And then when they find out it's all non-recourse collateral loan, you're like, holy cow. Holy cow.
Yes.
So let's talk about how do you, let's say that the first person that ever loaned you private money, how'd it go down? Tell us a story.
Oh, let me think about that for a second. The first person that ever loaned me private money was
it your dad, or was it a family member?
You know what? It was my grandparents, now that I think about it. That was back in 2006, I guess. So over 10 years ago. And this is before I knew anything about buying at a discount, Mitch. I was in college, actually. And I'm sure all of your viewers and listeners are familiar with house hacking. And that's what I did in college. So I bought a 4-bedroom house.
House hacking?
House hacking. You've heard of house hacking.
No.
What?
I'm
Really?
old, man. I'm old.
Oh man. Okay. Well, I'm going to teach you a little something today. So house hacking is very simple. And all that it really means is that you are going to buy a property, and it could be a single family home. It can be a duplex. It could be a quad. And essentially you're going to live in this property, but what you're going to do is you're going to rent out the other rooms. So this strategy is probably not a good strategy for somebody that's got a family, or children.
Oh, you're a college student and you wanted to not
But
you
if
wanted
you're
to leave for free.
Absolutely. And if you're a college student, this is a great strategy for you. I highly recommend it. I did it. Did I do it 3 times? I did it 2.5 times. And I'll explain that halftime here in a minute, while I was in college. But essentially what I did is I went and I found a 4-bedroom house.
And you just paid market. You just paid market.
And again, I didn't know anything about buying at a discount. I hired a real estate agent. I said, I want to buy a 4-bedroom house. I paid retail value for that. And I'll never, ever, ever do that again. But I didn't know. Okay. This is, I was in college. I was maybe 22 years old. And, I went and I got a real estate agent, and now me and him are partners on a whole bunch of units. We have about 10, 15 units together as well. But at the time, I didn't know him that well, and he was an agent, and he said, Dave, I can help you find a house. And we went out and we found a 4-bedroom house. I paid $165,000 for that house. I still own that house today. It was the very first one I bought. I only owe about 50 grand on it at this point, which is awesome. And I got a loan.
What's it worth? And what's it worth?
It's worth about 220, 230 right now.
Yeah. So you bought it for 60 or 70 or 80 or whatever, and all these years later.
I bought it for 160. It hasn't really appreciated all that much.
Wow, but between the debt reduction and the appreciation, you got a big gap.
I got a big gap. I got a lot of equity in there. That's right. So I bought it for 165, and it was just me. I had a girlfriend, but she was in a sorority at the time, so she wasn't living with me. I had a dog, and it was just me and my dog, right? And I had a 4-bedroom house. So what I did is I reached out to all my friends, and I said, hey, I got this 4-bedroom house. It's going to be awesome. Screw living in a dorm. If you're in a fraternity, that's one thing, but if you're not, come hang out with me, and I will rent these bedrooms out at $500 a bedroom. And I had 3 extra bedrooms, 4 total. I lived in 1. That brings 3 down. So I rented out the other 3 bedrooms. And I was bringing in $1,500 a month from those 3 bedrooms. Well, the mortgage on that property, and I'm going to guess here, but I think it was about $1,200. I refinanced it since, so it's changed. But at the time, it was about $1,200. And I was bringing in $1,500. So $300 isn't a ton of money to be bringing in. However, not only was I bringing in $300 in cash flow or net income, but I was living for free. Exactly. So I kind of digressed there, but essentially when I bought that property, it was $165,000. I'm going to get my calculator out here so we can make.
And your grandparents loaned you the money?
I bought it for $165,000. I got an 80% loan. So 165 times 0.8 is 132. 132 minus the 165 was 33,000. So I borrowed 33,000 from my grandparents, and they were really, really cool about lending it to me because, again, they knew that, if I screwed up, that we could just sell this house and that they would, get the majority of it back. But I didn't ever screw them, obviously. They were my grandparents and lenders. And what I did was I paid them all of the cash flow plus about half, maybe anywhere between a third and a half of all the money I was making at my little side jobs in college. And it probably took me about 4 years, to be honest with you, Mitch, to pay that $33,000 back. But my grandparents really weren't in a hurry to get it back. I was paying them a really, really low interest rate. I think I was paying them 5%. And at the end of the day, they probably would have gifted it to me, but I wasn't looking for that. I wanted to pay them back. And the reason is because I wanted to do this again and again and again. So what happened is,
can I stop you right there? That's exactly what happened with me. My dad loaned me $35,000. He wanted to, I wasn't even looking for a loan. He said, I want to give you you and your brother $35,000 a piece to start your lives with. But it's your time now. So when do you want your $35,000? I said, I don't want it. I'll borrow it. And I said, I'll pay you back at 10%. And if I can't borrow it and pay you back at 10%, then I don't deserve your money.
That's awesome.
And because I had the same thing. I know how much money my dad had. He didn't have a lot, but he had a lot more than 35,000. And I wanted to be able to help him and help myself with all of it. You know what I mean? Eventually.
Right. I love it. Very similar.
You were doing the same thing, right? You were looking ahead.
Absolutely.
Like, don't give me crap. Go into business with me and loan me everything.
Right. So that's what I did, Mitch. I got that 33,000. I didn't get it. I borrowed it, and then I had to give it to, put it down on the property. And then the bank gave me an 80% loan. Again, the mortgage payment was only about $1,200, and I was bringing in about $1,500. So at the end of the day, I was living for free. It was basically covering, all of my living expenses. I was making about $300 in cash flow, which I would send to my grandparents every month, plus anywhere between an additional $250 and $700. Again, it was, roughly a third to a half of what I was making at my little side jobs. And in college, everyone's got random jobs, delivering pizzas, working at sandwich shops, whatever it might be. I worked at a commercial real estate firm as an intern, making like $5 or $6 an hour. So I wasn't making a ton of money, but I was making some money, and I was taking that money and I was paying back that debt. And so this is a little different than most people. Most people will just make those interest payments. Whereas my loan to my grandparents, I was paying principal and interest. I was trying to pay that $33,000 off.
Yeah.
Plus,
if you're like me,
plus the interest.
That first debt scared the hell out of you.
Yep, absolutely. And I was taking on, double shifts over the weekend just because, my grandparents were, and they're not with us anymore, but they were great, great people. And really they were just trying to help me out. But to me, it was like, well, I want to do this 10 more times. And, if I don't pay them back any, then they're not going to have trust in me. So, after about the first year, I had probably paid back, anywhere between 7 and 10,000 of that 33. And I wanted to do it again. And even though I hadn't completely paid back that entire sum, I was making payments. I was making them on time, and I was paying not only the principal, but the interest. And I wanted to do it again. So I found another house in the neighborhood. This time it was a 3-bedroom house, but I got a much better deal on it. Instead of $165,000, I think I paid $125,000 for it. And what I did was I moved into that property because, again, I wanted these loans. I wanted to get a good rate. So I wanted to get primary residence type of loans, right? So what I did was, after I had established that first loan, and I had those 3 roommates, I said, okay, if you guys want to stay, great. If you don't, I'm going to find other people. And essentially what I did is I moved into this new one, and now I had 4 people living in this one, paying $500 a month. And my cash flow went up because instead of me only making, $300 a month from the 12 to the 15, now I'm making
8.
Now I'm making 8 because I was going from $1,200 a month in mortgage to $2,000. So 500 times 4 is 2,000. And now I was making pretty decent cash flow on this property. So I did it again. I went and I got another loan from them. I bought a 3-bedroom this time, and then I rented out 2 of those bedrooms. I actually did this 3 times, or I want to say 2.5, because the third one I bought, I didn't move into. I just bought it and I rented it out, but it was the exact same scenario where I didn't know about buying at a discount. I didn't know about motivated sellers. I was buying market rate, retail cost, using an agent. And, but it was okay. It still worked out. And I still own 2 of those 3. I sold off one of them, and they do great for me. They cash flow awesome.
That strategy of leasing to students around the colleges is a huge strategy. If you guys are interested in that strategy, go to my interview with Dixie. Dixie Decker's knocking the bottom out of that thing, and she's got it all figured out, how to get the parents on the hook and everything. I'm not downplaying you, but your system at that time was probably a little light.
Oh, absolutely. You're not offending me, Mitch, at all. Trust me. I didn't have.
She's written out, all around the campus, and like she's experienced all the problems and then plugged up all the holes in the bucket, because if you're like me, ready, aim, fire, you're just. Your paperwork was light. Everything was light. I'm sure if you did it again today, you'd be like,
I'm more of a ready, fire, aim kind of guy. Absolutely. But you know what? It worked out really well, Mitch. And, but that's house hacking. All that really means is that you buy a property, you move into it, and you rent out the additional rooms. A lot of people do this here in my local market with duplexes. They'll move into, a duplex that's got like a 2-bed, 1-bath, but 2 units, right? And they and their spouse, or they by themselves maybe, will live in one of those units, and they'll rent out the other one. And that's house hacking. But essentially what the goal there is to live for little to no money, like basically live for free. Or in some scenarios, maybe you have to pay a little bit towards the mortgage, but instead of you making the entire $800 or $1,200 mortgage payment, you're only paying $200 towards it. So it's a way to acquire wealth. Now, it's a slow game. We all know that. But it's a way to acquire wealth, reduce your costs, and have a place to live, and that you could also rent out at the same time. Very cool
I'll
strategy.
start slow, but the point was you got your first money from your grandparents, and then how are you able to buy the other two houses? Did they do it again with you?
They did it again with me. Yep, absolutely.
Because you paid down rapidly, and you didn't mess around, and you were trying to make a point, and you did make a point. That's what I'm getting to. And
Yep.
so my first was my dad. Same thing. But then, do you remember the first person you borrowed money from that wasn't your family member?
I do. Yeah. Actually, now he's one of my business partners, which is really cool. But so after college, I did that 2.5 times, called 3 times in college, where I essentially bought 3 properties. And I say a half because I didn't move into that third one. But I house hacked the first 2, and then I guess just bought a rental on that third one. But I did that 3 times in college. And then after college, I went and took a couple different jobs doing sales and marketing. And again, I still didn't know about buying at a discount. I didn't know about motivated sellers. And I ended up buying about 5 more houses over the next 5 to 6 years. And then I said, you know what, I'm going to do real estate full time. And that's when I learned about buying at a discount. So what I was doing whenever I decided to quit my job, and I did, I went in, full throttle. I didn't have a plan B, Mitch. I went in, I said, I'm going to make this work. I don't want to have a plan B, because if you have a plan B, typically you're not going to have as much trust in yourself.
You burned your boats.
I burned my boats. You nailed it. I burned my boats. And what I started doing is I started, buying courses and reading books. And I probably read 100 real estate books over that, 3 to 4 month period after I quit my job. And I learned about wholesaling. I hired a local coach to kind of get my feet wet. And then what I was doing is, when you're wholesaling a property, you don't really have to have money. You are the cash buyer, but it's really contingent upon your partners, your partner's approval, which could be your cash buyers. It could be anybody and everybody. But once you want to start buying rentals or do flips, you need to be able to close on those properties. So I was going to a lot of different real estate clubs around town, and I was meeting other investors. And I was actually meeting a lot of people that just wanted to partner with me. They liked my energy. They knew that, that I was committed. They knew that I was going to come across good deals. And some of them wanted to buy those deals from me, but some of those people wanted to actually just partner with me on deals. So the first private money that I got outside of family was not even people lending money to me. It was, hey, let's partner on a flip. I didn't have any money, but they did, but I had the deal. So what I did was I'd go find the deal, and then they would purchase the property, and then either me and them together would work on the rehab, or in some scenarios, they would do all of the work, but I would have the deal. And the splits would be anywhere from, 80-20 to 50-50. And, depending on how much money and or effort that was required. And I did 5 or 6 deals that way, where we would flip those properties. They would have 100% of their money invested in the purchase and the rehab. And then we would go and sell those properties, and I would make a little percent. Well, after we did that 5 or 6 times, I realized that I could make more money than if I didn't partner with them, if I just borrowed the money from them and paid them an interest rate. And some of the guys wanted to keep partnering with me.
The money you'll ever have is a 50-50 partner, right?
It's the most expensive money you can have. Absolutely. I love it.
There's a lot of synergy there, though. If you get with the right partner, I mean, like if you're doing 50-50 and the money guy's just the money guy, like he's a doctor and he's not going to put anything, he doesn't even know about the business. That's a really expensive, hard kind of money, because you're just getting the money and you're giving up 50% of your profit. And while we've all done it, and it's okay to do for a while, you start to figure out, I would be much better off if I'm going to have a partner, that he be sharper than me, more connected to me, be longer in the business and have more experience with me. And I'll split with that guy for 50-50, because I'm going to get some education out of it. Plus I'm going to get the money.
And that's the thing, Mitch, you nailed it. Like looking back in hindsight, I don't have any regrets on anything I've done in real estate, in terms of buying or borrowing or partnering with people, because all along the way, I learned valuable lessons. And I made a lot of great friends, and some of these people I'm partnered with today. Absolutely.
You get some confidence, and then, I don't believe in just getting what you need and running off from a relationship, but relationships have a way to have their opportunities to part or just they want to slow down, or I don't know. There's lots of times if you just sit back, don't get in a hurry to be your own guy, but it'll come up. The opportunity will come up, and then you go out and you start borrowing money at 8, 9, 10, 12%, and it's a lot cheaper than 50%.
It's a whole lot cheaper, man. You nailed it. Absolutely. Whole lot cheaper. So what I did in the beginning, like I said, I house hacked in the very, very beginning. And then I started joint venturing, 50-50 partners, or in some scenarios the ratio might be a little different, but essentially it was a 50-50 partner where I'd go find the deal and they wanted to, do the fix and flip. And then I kind of got a little wiser, and just like we're talking about now. And I said, you know what, I'd rather just borrow this money from these people because, I'm giving up 50%, whereas I could, maybe borrow this money at 8 or 10 or even 12%. And it would be a lot more profitable to me. And I started doing that where I was buying properties and, and fixing them up and flipping those and then just paying those, paying the interest. And it's just kind of snowballed since then. So right now we have about, probably have 5 or 6 different private lenders that we can kind of pick from.
What are your rates? Can you tell us what
I would be happy to, Mitch. I'd be happy to. So what we do now ours is a little different because we're not borrowing money long term. I know whenever you do a lot of yours with the owner financing, you're borrowing 5 years, and it varies, of course.
Yeah, we are typically got to be wrappable because I got to be able to sell the house,
and they got to be wrappable too. Absolutely right. Whereas when we borrow,
in and out, right?
We're in and out. Yep. So we're typically looking for a 6-month loan. However, we always ask for a year, even though our goal is 6 months, but I don't want to have to go back and renew or to disappoint somebody. So I always just say, hey, the goal is to get the money back in 4 to 6 months, but I'm going to borrow it for a year just because I don't want to have to redo this paperwork or get late and disappoint you. And there has been some scenarios where it's taken me 8 or 9 months, and it's been good to know that I have positioned myself from the beginning asking for a year, even though I said, we're going to try to get this back in 4 to 6. So all the loans that we have, pardon me, I got a cough. All the loans that we have, they're 1-year loans and they're interest only loans. Now we actually give our lenders, Mitch, we give them a choice. We pay 8. I'm sorry, not 8. I wish we paid 8. We paid 10 or 12%. And we let the lender pick. So what we do is we say, hey, we'll give you 10% or we'll give you 12%. But there's going to be there's going to be some terms on both of these, and that's why there's going to be different. So if you want 10%, no problem. I'll pay you monthly payments each month until I can get the initial principal back. Or I'll pay you 12%, but it's 100% in the rears.
Yeah, no payment.
No payments. You're going to lend me.
You get paid off the principal you loan, plus you get paid the 12% for how many days you had it out.
Absolutely. And most of our lenders, I don't want to say all, but most of our lenders, they will lend 100% of the purchase and 100% of the rehab. Some of our lenders will do 100% of the purchase and then maybe half the rehab, or some of them will even just do 100% of the purchase and none of the rehab. So it just kind of depends on what the deal looks like, depending on, who we're going to be reaching out to get that money from. But as you build experience, and this isn't just me, this is anybody and everybody that's listening right now. As you build experience, as you build credibility, as you build trust with these private lenders, they are going to give you better terms. And I'm not saying a better rate, but they're going to give you more money. So in the beginning, I may have only got 100% of the purchase price and none of the rehab, which is okay. I had some money from wholesaling or, rental cash flow that I could use to do that.
Or a 0% credit card.
Or a 0% credit card. You nailed it, right? But as you build credibility, experience, and trust with these people, they want to make it easier for you, and they want to deploy more capital to get more of a return on their money. And we're at the point now where, again, we've built the credibility and the trust with these people, where we'll typically get 100% of the rehab and anywhere between 75 and 100%. I'm sorry, 100% of the purchase. I said that wrong. And then anywhere between 75 and 100% of the rehab as well. And it makes it really easy for us because, again, we can provide that convenience to our sellers. No matter what, we're not going to buy it if we can't get a discount. I mean, that's just goes without saying, period. I don't buy properties if I can't get a discount, no matter what, period, right? But if I can get a discount on those properties and I can provide convenience to those sellers, then we need to be able to close those properties fast. So that's where the private lenders come in. Having the ability to pay cash is huge. And there's been a lot of times where I've even won deals where my offer was less. I'm talking 15, 20% less than somebody else might have been offering, but I can close next Tuesday and they might not be able to close for 45 to 60 days. And having the ability to buy with cash and provide that convenience, I'm talking true convenience to that motivated seller, to that property owner, it really helps a ton. So having private lenders has really, changed our business and just made it a whole lot easier, not only to grow the business, but also to get better deals too. So there's just a lot of advantages all the way around.
So I want to thank you for pointing out, because I do need to make this, point out this difference. I need $22 million because I'm getting money out. I sell my houses on 30-year fixed mortgages. So I have to have a longer term money. So when I get $1 million in one place and then I go ahead and buy my houses, I need to have that money for a much longer period of time. It doesn't come right back. When you're just flipping or wholesaling or fix and flipping, you don't need $22 million really, because the money's going out, but it's coming back in a relatively short amount of time, sometimes in weeks or days if you're wholesaling, right? It's just going out and it's coming back. But I do like the idea of even you wholesalers, because there's ways to wholesale, right, where you don't need any money. But the pressure of that is big. And also you can ruin your reputation, because when you bet on just time, I have 30 days to close and I don't have any money. And if I don't flip this contract in 30 days or however many days you were given, then you got egg on your face with your seller, right? And it's just bad juju. What I like about having the private money is that you can close on deals, even if you think you're going to do them quickly, you can close on them. You can slow down. You can take a breath. I know wholesalers that have to keep dealing with the same cheapskates all the time because they can't take a chance on a guy they never met, because what if he doesn't perform? I'm going to lose everything. I'm going to lose my deal, right? So
Absolutely.
Go ahead and fund it. Slow down, calm down. Take your time. You don't have, I know your contract runs out in 10 more days. It doesn't matter if you go ahead and buy it. You can take another 30 days and find a buyer that's willing to pay twice as much profit, than another person. So private money, it looks like it costs you money, but it probably makes you money, because you can just calm the hell down, take your time. You can even go in and fix a couple of major things if that's really what's holding up this sale, because now you own it, and you can find the right guy. You can take a chance on a wild horse that's coming down the road. You can take a chance on him. If he flips out, no big deal. I still own the house. It cost me a couple of days of interest, but no big deal. And I'll go call my tried and true guys tomorrow and I'll get it done, But
right.
And I think a lot of wholesalers are doing that right now. It's called the greater fool theory. They got their go-to guys that they can do a true wholesale price, but they're just trying to find these people coming from places like California and China and wherever that think $100,000 house, when we all know it's a $60,000 house, and they're selling these people these houses at incredible prices. I'll give you a hack. I'll give you a house hack for you. Okay.
Let's hear it.
Now I'm a house hacker. I heard the theory. I had a couple of problem houses that were kind of sitting in the back burner. I was kind of ignoring them because I already tried to sell them and I wasn't working out. And just through a couple of circumstances, I was kind of upside down on these houses.
Okay.
In a different chain of events, I was at an auction and I saw a couple of people buy some houses on some streets I knew very well, and I knew more or less where that house was, on what block, and I couldn't believe what they paid for those houses. So I went and talked to them. Said, "How'd you buy that house?" Well, the one lady says, one guy wouldn't talk to me. The other lady said, "Well, we're from California, and my husband said we had so much to spend on houses, and this was in my budget."
Oh wow. They were just buying based on what's in the budget.
Seen the house. She'd never done a comp on it. She didn't do anything. She just like, you know, he wants to buy 10 houses, $100,000 more or less. Well, this one was $100,000 more or less, so she bought it. I thought, my God, I got to get my 2 houses down here. I foreclosed on myself, which means if the auction is Tuesday, that's a week, you know, I can foreclose on myself and just call the trustee. I don't even have to do any paperwork because the only person that could protest the foreclosure is the guy that's getting foreclosed on, and it was me. So I got to protest myself. And so I got to the auction like in a few days, and I sold those houses for about a $5,000 profit when I was going to have a loss, and another one for a $7,000 profit when I thought I was going to have a loss. And I had my money in 3 days. So if you really got an upside down house and you don't have anything else better to do and you run out of ideas, just take it to the auction and watch what happens. Maybe you're lucky, man. I didn't foreclose on myself. I put it into an entity so that Mitch Stephen wouldn't have a foreclosure on his name, even though it probably wouldn't matter and it was nothing. It wouldn't show up anywhere. I just got my name. I value my name a lot, and I'm not going to put one on me. So I had it in a land trust, and I foreclosed on a land trust, right? So, but the point is, there's a little hack, you know. Just I foreclosed.
Absolutely.
Got rid of my houses. I had my cash in 3 days, and I actually made money when I thought I was going to lose money because there's a bunch of fools down there right now.
Yep. Absolutely. So Mitch, you know what we're doing now mostly with our private funds. And again, I know your model is a lot different than ours because you're doing the long-term owner finance. And I'm looking to start doing some of that myself, but as of today, I'm not yet. But what we are using our private funds for a lot right now is the BRRRR strategy. And it's helping us acquire a lot of rental properties. So yes, we borrow for our fix and flips, of course. But what we've been doing more and more of recently is we're buying rental properties, but we're still using those private lenders. We are borrowing 100% of the purchase and 100% of the rehab. Again, we're getting a good deal on these because we're offering convenience and we're getting a discount. And then what we're doing is we're going in and we're spending anywhere between, typically the minimum is about $15,000 of repairs. And there's a reason for that. So I'm going to circle back to that in 1 second here. But we're typically doing a minimum of $15,000, in some scenarios, $20,000 to $25,000 worth of repairs. But then what we do is we go to our bankers and we get that property appraised once it is purchased, rehabbed, and rented. So we now have a tenant in there paying us. And we go to our bankers and they are giving us loans based upon either 70, 75, or in some cases, even 80% of what it appraises for. So why would I say that I need to spend at least $15,000? Well, there's a big difference between getting a loan based upon an appraisal, like a percentage of the appraisal, or getting a loan based upon the percentage of what you purchased and spent. So if I can add enough value to these properties, I can essentially get these properties for nothing in the end.
Or I'm going to venture to say you might even be cashing out sometimes.
Sometimes, yep. Now we don't typically like to walk with money. We'd rather just have less debt service. But there are scenarios where we'll walk with 2 or 3. We actually did one yesterday.
But if you stole a house for $10,000 for some reason and it was worth $100,000 and you had to put 30 into it, you're still going to borrow $60,000, $70,000, right? You just don't want to over leverage.
Absolutely. So we did one yesterday where it was a duplex. Now we bought this house with private funds about 6 months ago. The property needed a full rehab. I think we probably spent maybe around $40,000, so $20,000 a unit rehabbing it. The property, each unit rents for $900, so that's $1,800 total income off the property. The property appraised for, a lot more than what we were into it for. So we got a 75% loan and we actually walked with about $2,000. So it wasn't like a ton of money, but we were able to pay back all of the private lenders' money, not only the principal, but all the interest too. So that private lender is ecstatic with me. They're like, this is great. Go find another property. I don't want this money in my checking account. I want to give it back to you so I can get this interest again. So we were able to, buy the money with private funds, rehab it, get it rented, and then we got a loan based on the appraisal. So why is it important to be able to get these loans based on the appraisal versus the purchase and rehab? Because no matter what, if you are getting a loan based upon a percentage of your purchase and rehab, no matter what, you're going to be leaving money in that deal. I don't care what the numbers are, because you're only getting, let's just use simple math. You're only going to be able to get 75% of a loan on what you spent. So if you spend 100,000,
you're leaving money in it no matter what. 75% of something, it still leaves you. You're still leaving in.
You're still leaving 25% in. So what we did is we went to our bankers, and hopefully this is a good nugget for the listeners here. We went to our bankers and we said, we've been hearing about people getting loans on based on the appraisal and not necessarily caring so much about it, sending over a spreadsheet with, what I bought it and what I spent on it. What do we need to do as real estate investors to be able to get these loans based on the appraisal? And for you guys, you as the bankers, to not care so much about what we bought it for, because we're always getting that discount, and what we spent. And my banker came back to me and he said, there's typically 2 or 3 things that are going to they're going to allow us to lend on the appraised amount and not the purchase plus rehab. And those things are experience. You got to have experience. If this is your first property, I'm not saying that you can't do it, but most bankers aren't going to want you to do that. They're going to want you to have some skin in the game. So once you have some experience and either some flips or some rentals under your belt, that's one way to go about doing it. But the second way is that in order for them and their own, regulations with the government and whoever else is regulating these banks, in order for them to do that, they need you to spend, or at least for me in my market, at least $15,000 updating, renovating, rehabbing, whatever you want to call it, these properties. And because if we spend at least $15,000, they give us what's called the entrepreneurial credit. Now, don't quote me on that, because every bank may have a different term for it. Every market may have a different term for it. But my bankers, they refer to it as an entrepreneurial credit. So if they can say, Dave, we don't care what you bought this property for anymore, right? That's your business, which is awesome. Because in the beginning, I had to provide them a HUD plus a spreadsheet with receipts for all the costs. Now, as long as I spend at least $15,000 on the rehab, which is very, very easy to prove, I can either send them a spreadsheet for that, or in some cases, I'll just send them before and after pics. Literally 3 to 5 pics before, 3 to 5 pics after of the kitchen, the bath, the roof, the flooring, whatever it might be. And they say, okay, cool. It looks like you spent at least 15 grand. And then what they do is they give me what's called the entrepreneurial credit. And then they no longer care what I bought it for and what I spent. At that point, they just say, hey, we're going to send an appraiser out. We're going to appraise this property. Let's say the appraiser comes back at 100,000 and I'm all into this property for 68. Let's say that, the neighborhood only, and again, they lend 70, 75, or 80% in my market, depending on the neighborhood, right? So let's assume in this scenario that it was only a 70% loan. Well, it doesn't matter, because I'm all in at 68, and that's with all my costs. So they're going to then give me a loan at 70 grand when I only owe 68. So in that scenario, I pay back my lender. I walk with a little bit of money. And again, I don't always walk with money, but in some scenarios I do. But the main thing is I just acquired an asset with none of my own money. I paid back my lender in full. And now I have a property that has been rehabbed. Now, I'm not just saying I have a property. I have a property that has been rehabbed and is rented with a lease in place, cash flowing for none of my own money out of pocket. All right. Now I want to just say one thing real quick, Mitch. Yes, there was some of my money in some scenarios out of pocket in the beginning or in this process. When I say none of my own money, I'm referring to the exit. I'm referring to once I go to the bank and I get the appraisal and I get the refinance, none of my own money is invested in that deal, because they have given me a loan for either what I owe or some cases a little more. And everyone gets paid back, and now I have acquired the asset. So not always do I get $0 in. I would say in the last 12 months, Mitch, we have done this BRRRR strategy. If you're not familiar with the BRRRR strategy, it stands for buy, rehab or renovate, rent, refinance, and repeat. But we have done this BRRRR strategy over 45 times in the last 12 months. And the average amount of money that we've left in these deals is $1,200. The average.
There you go. And you get that back pretty quick. So
the reason that it's not zero is because, you don't know what these properties are going to appraise for until you get the appraisal back. Oftentimes you may think that the rehab may be 20 and it ends up being 25. So as you do this more and more, you get better at it.
the rehab goes over. That's almost like every time in my book.
Almost every time. Absolutely. You're absolutely right. But what happens is as you get better and better at it, you start getting these at $0 out of pocket, or in some cases you either walk with money, right? So what we've done just recently is we've looked at some, and in the beginning we were leaving 3, 5, sometimes 6, 8 grand in these deals because we did, we were learning. But now we're to the point where we should either get all of our money back and be into it for 0, or even walk with a little bit. So if you average all of these deals over the last year, that's about 45 that we've turned. The average per deal is only about 1,200. And as you stated, you get that back relatively quickly with the cash flow.
Yeah. So, I was doing about 100 houses a year too, but I have private lenders. They're loaning me some longer term money, 5 years, 10 years, 15 years. I borrow money 8% interest, 5 years. 10, that's 8%. 9% is 10 years fixed, fully amortized. 10% is 15 years fully amortized. And then there's hybrids off of that. Maybe I give you 9% if you give me a 15-year amortization with a 7-year balloon, or you know what I mean?
Right.
Give me a 10-year. Maybe I'll pay you 7% if you give me a 10-year amortization with a 6-year balloon, you know what I mean, or a 5-year balloon. I mean, you just play with it.
Absolutely.
But these loans are collateral only, non-recourse. You don't sign personally. Wrappable, payable monthly. You can even make an option where they get paid in arrears, but my time frame is so long that it would make people really nervous. You know what I mean?
Yeah, I get that. Absolutely. So your 8% are only interest only. And then when you do the 9 or the 10 at either 10 or a 15-year term, you fully amortize those loans with those people.
Yeah, because my interest only still leaves me with something to do in the future, and I still have to address it. So I started trying to find younger people that had IRAs where they couldn't even get to their money for 20 years, and they're more like, just let me set it and forget it. I'll do a 15-year am. Of course, it's not up to me whether it goes 15 years or not. It's up to the person that owes me money. If they want to pay me off, I have to pay them off. So, none of the loans really go 15 years. By the way, if you're interested in loaning out your money and getting out of the stock market and quit living by that ticker tape, or if you're interested in not making more than 1%, I mean, here's two guys right here that, not only offer you a higher, actually better than average rate with more security than any of these other people are really giving you. I guess the bank supposedly is FDI insured, but it's been my experience is that when the government fails, it fails so big, no one's going to take care of it. You know what I mean? So
that's correct. Yep.
I mean, and then depends on how much money you have, because they only insure so much per bank or bank account. So anyway, think about, if you've been looking at this house flipping creative real estate model and are coming to the conclusion that it's not for you because it is work, right? It's work, Dave. I mean,
it is. Absolutely. Absolutely.
It's not like they make it sound like on Flip This Whatever on A&E. I mean, they make
I've never flipped a house in an hour. It's never happened. That's right.
Think about loaning out some money with some real collateral. Just the secret is make sure that you're happy with the collateral and what's backing up whatever the amount that you loaned. And if you're happy with it, then do the loan. And if you're not happy, don't do the loan. Make sure you get real documents. And how what separates, I always get calls from private lenders after they watch a couple of episodes of American they'll be wanting to know, am I on one of these pyramid schemes? I say, no, here's the difference. That guy that you saw that was borrowing money on real estate never got the county clerk's notarized signature, and it was never filed at the courthouse, and you never had a first lien. You just signed some papers, and then he went to the next town and he got some more people to sign some more papers on the same house, and then he went to the next town and he never gave anybody a first lien on anything. Everybody walking around with stupid pieces of paper. I said, so this is what I want you to do. You loaned me money, right? So I want you to go find your papers and look where it has the time, date stamp and the notarized signature by the county clerk, and then get online and see where you're the first lien holder online.
Right.
Now that's the difference between a con man and someone who's really doing the business right.
Right.
And someone who knows how to loan money right. So, man, we can
absolutely.
Dave. You gonna come back and see me sometime?
Hell yeah, man. I'm gonna come back. I'd like to maybe get down there sometime maybe late January, early February. That'd be awesome.
Bring your partner.
I would love to do that. That would be great.
All right. All right. Well, man, we got to wrap it up. I like to, if you guys want to learn more about raising private money, go to ariinvestorsummit.com/PMCE, which stands for Private Money Changes Everything. I have a course out there. You can also find it, 1000houses.com. I've changed a lot of people's life with that. It's not that complicated to go raise private money, but everyone's afraid of it before they do it. Everyone's afraid of it. If they haven't done it, they're afraid of it. All you got to just nose to nose with it, figure out how it works, how you're going to talk, get your conversation mapped out, learn the 21 objections and how to answer them, and get a plan and go out there and put up the numbers. If you put up the numbers, you'll find money. I mean, I challenge you to get 50 no's in a row. You can't do it.
That's right.
You know what you're talking about, and you got a plan, and you're going to go present. And you know what you're and you should be able to do it on a napkin with a pencil, because that makes it look really unsophisticated. People don't want to loan money on sophisticated stuff. You get out there with your PowerPoint, and you're doing all this stuff. They're like, damn.
I totally agree, Mitch. I totally agree. People, when you make it complicated, it scares them. If you can just do it so simple. I don't use a napkin, but I mean, I'm talking like a scratch paper, right?
Yeah,
it's so simple.
Hey, give me this piece of paper. Look, this house is worth 100 grand. I need to borrow 40, and I'm going to give you a first lien. If I don't pay you, you get my house.
You get the house.
If I can't pay you, I'll bring you, I'll walk it to you. But if that turns out not to be the case, you hire an attorney for $800. I'll give you his name, and they'll have this house for you in 90 days. You're going to make big money on that. As a matter of fact, the worst thing's going to happen is I'm going to pay you on time, because that's the worst thing that's going to happen. Because if I don't pay you on time, you're going to get that piece of that property, and you're going to make way more money than what I'm paying you. But if you're going to loan me the money thinking you're going to get that property, don't hold your breath, brother, because it ain't ever happened.
Right.
It ain't happened yet. You'll be the first one. If it happens, you'll be the first one.
Yep, that's right. Well, Mitch, yeah, thank you so much for having me on again, buddy. I appreciate your time, and it's always good catching up with you. And yeah, anybody that's listening, if you're not using private money, you should be. It's going to make your business definitely change in a big way. So I highly encourage it.
Making a great living and becoming a multi-millionaire. It can make that difference in a heartbeat. All right, you guys, this is Mitch Stephen with the Real Estate Investor Summit podcast. I would like to pay homage to my sponsor, taxfreefuture.com. If you do not have a tax-deferred or tax-free retirement plan with checkbook control, you have no idea the size of the hammer that you are missing in your tool belt. We're going to tell you what your financial advisors are not telling you. You won't believe it. And then we're going to tell you why, and it's all going to make sense. Go to taxfreefuture.com. Watch the 37 little video vignettes by signing up, giving a little bit of your information, and we'll let you take a look at these 37 video vignettes that tell you all kinds of things. One of the most important things it tells you is how to make a whole bunch of money starting with a very tiny amount in your account, like $200 or $250. Most people don't know how to proliferate from there. They think, well, it's going to take forever to grow $250 to $10,000. No, it can be done in one move. You know what I mean? You just got to know how to do that move. If you want to learn to dance, you got to take dancing lessons. Okay. Talk to you in a bit, you guys. This is Mitch Stephen. We're out of here.